Hi and welcome to this new video. Today we're breaking down GPTY, a YieldMax ETF that's been getting attention for one reason: a distribution rate north of 35%. That number is eye-catching, but it comes with real trade-offs: technology concentration, variable payments, capped upside, and the risk of eroding your own capital over time. In this video, we'll go through exactly what GPTY owns, where that income actually comes from, whether it's sustainable, and how it compares to other income ETFs. My name is Rashid. I'm a CPA with a master's degree in finance, and I'm not a financial advisor. So always do your own research, and consider speaking with a professional before making any investment decisions. And if you want a structured way to combine funds like this into a diversified portfolio, my model portfolios are linked in the description below. Here's the core idea to keep in mind for the rest of this video. Option income can change how your return shows up as cash in your account instead of share price growth, but it does not eliminate market risk. Let's dig into why. So what exactly is GPTY? At its core, it's a fund that owns real shares, not just derivatives, in about 15 to 30 AI and technology companies. On top of that stock ownership, the fund's managers actively sell options contracts against those holdings every week, and use the cash collected from those trades to fund a weekly distribution to shareholders. That's the basic engine: real stock ownership, plus an options strategy layered on top, designed to convert some of that portfolio's volatility into a steady stream of weekly payments. Whether that's a good fit for your portfolio depends entirely on what you're using it for: income today, or growth over the long run. We'll come back to that question throughout this video. Let's look at the basic profile. GPTY is issued by YieldMax, trades on the NYSE ACA exchange, and was launched on January 22, 2025. So it's still a fairly young fund. It pays distributions weekly, carries a gross expense ratio of 1.06%, and currently manages about $129.7 million in assets. The way I'd summarize this fund in one line: it's a diversified technology fund on paper, but it's still concentrated in one sector. 15 to 30 holdings sounds like real diversification, but when all of them are pulled from the same corner of the market, that diversification is more limited than the number suggests. Let's get specific. The fund's major holdings include Nvidia, Snowflake, Alphabet, Palantir, Microsoft, IBM, Apple, Amazon, Marvell, and AMD. And here's the important part: more than half of the entire portfolio is concentrated in just its 10 largest positions. So yes, technically you own several different companies, but economically, you're really making one bet on AI and large-cap technology continuing to perform well. If you already hold significant technology exposure elsewhere in your portfolio, say through a NASDAQ 100 fund or individual tech stocks, adding GPTY on top could push your overall allocation into riskier concentration territory without you realizing it. That's the portfolio fit question to ask yourself before buying in. Now, where does that weekly cash actually come from? There are three sources. First, stock dividends, but most AI and tech companies pay little to nothing in dividends, so this is a small piece. Second, option premiums, which is the fund's main income engine. And third, amounts classified as return of capital, which is essentially your own invested money being handed back to you. The key takeaway here: most of this fund's cash flow does not come from traditional dividends the way a typical income stock would pay you. It's manufactured, largely through the options strategy, which is neither good nor bad on its own, but it does behave very differently from the kind of income you'd get from, say, a dividend-paying blue-chip stock or a bond. Let's talk about the mechanics for a moment, because this actually matters for your returns. A basic covered call strategy sells just one call option against a stock. That collects a larger premium, but it caps 100% of your upside above that strike price. If the stock takes off, you don't participate at all beyond that point. GPTY does something a bit different: a call spread. It sells a call at a lower strike price, and at the same time buys a call at a higher strike price. That means it collects a smaller net premium than a plain covered call would, but in exchange, the position can still gain value if the stock rises above that higher strike. In other words, more upside potential than a simple covered call fund, but the downside risk of owning the stock in the first place is still fully there. This is a real structural advantage over some simpler covered call products, but it doesn't turn GPTY into a low-risk holding. This is probably the single most important slide in this video, So let's slow down here. That headline distribution rate, currently around 35%, is calculated by annualizing one recent weekly payment and comparing it to the fund's current price. That is not a guaranteed yield. It is not your expected total return. And it is not a fixed annual interest rate the way a GIC or a bond coupon would be. It's simply a snapshot, stretched out over a year, of what one payment would add up to if it repeated exactly every week, which it doesn't. Distribution rate is not the same thing as investment return, and mixing those two up is probably the single most common mistake investors make with funds like this. So is that income real? Yes, the cash lands in your account. But here's the nuance. Receiving $1 in cash does not automatically make you $1 wealthier. An ETF's share price normally adjusts downward to reflect a distribution that's just been paid out, and part of that payment can represent your own capital being returned to you, rather than new investment gains. This is why you can never look at the distribution alone. You always have to combine it with what's happening to the fund's price, or NAV, over the same period. A big weekly deposit next to a shrinking share price isn't the win it might look like on the surface. Let's talk about return of capital, or ROC, a bit more directly, because it gets a bad reputation that isn't always deserved. Part of this is simply a tax classification. Option income can legally be labeled as return of capital for tax purposes, even in weeks when the fund generated real economic gains. That mainly affects how the payment is taxed, not necessarily whether the fund is losing value. Where it actually becomes concerning is when distributions repeatedly exceed the fund's real returns, and the share price keeps declining as a result, week after week, month after month. So the rule of thumb, return of capital by itself is not the verdict. Persistent NAV erosion, the fund's price steadily trending down over time, is the real warning sign to watch for. Let's look at actual numbers. Over the 12 weeks ending August 19, 2026, GPTY paid out approximately $3.83 per share in total. Individual weekly payments ranged from about $0.276 up to $0.383, and the return of capital estimate on those payments swung anywhere from 0% to nearly 100%, depending on the week. That's a wide range, and it tells you something important. Both the size of the payment and what it's actually made of can change dramatically from one week to the next. If you're planning to rely on this income for regular expenses, that variability is something you need to budget around, not assume away. So will this keep up? Payments depend heavily on market volatility. When AI and tech stocks are swinging widely, options premiums tend to be richer, which supports bigger distributions. When markets calm down, those premiums shrink, and so does the income. And here's the piece that's easy to overlook. GPTY hasn't yet lived through a prolonged bear market in AI or technology stocks. Everything we've seen from this fund so far has happened during a strong bull run. A recent annualized rate, no matter how impressive it looks today, should never be treated as permanent, guaranteed income going forward. Now let's look at how an actual investment would have performed. $10,000 invested at GPTY's inception, with all distributions reinvested, grew to approximately $13,964 by July 2026. A solid result, and one that actually outpaced the S&P 500 over the same window. But context matters enormously here. This happened during a powerful AI bull market, arguably one of the best possible environments for this type of strategy. It tells us the fund can perform well when conditions are favorable. It tells us nothing yet about how it performs in a prolonged downturn, because that test simply hasn't happened. Let's bring this back to the core question we started with. Everything we've covered, the technology concentration, the variable weekly payments, the capped but not fully capped upside from the call spread strategy, the risk of NAV erosion, and that 1.06% expense ratio, all of it comes back to one idea. Option income changes how your return is delivered to you. It does not eliminate the underlying market risk of owning volatile technology stocks. With that fully in mind, let's see how GPTY actually stacks up against some of its closest alternatives. Here's a side-by-side comparison. GPTY holds 15 to 30 AI and tech stocks, yields approximately 35.6%, charges a 1.06% fee, and carries high risk as a young fund concentrated in one sector. YieldMax holds just 7 Magnificent 7 mega-cap stocks, yields roughly 48.7%, charges 1.12%, and is very high risk, even more concentrated than GPTY. CHPY holds 15 to 30 semiconductor stocks only, yields around 39%, charges 0.99%, and is also very high risk, since it's a single, extremely volatile subsector. On the other end of the spectrum, QQQI holds the full Nasdaq 100, roughly 100 companies, yields about 14%, charges 0.68%, and carries moderate risk thanks to that broader base. In JEPQ, also tracking the full Nasdaq 100, yields around 11%, charges just 0.35%, and is the lowest risk option in this group, the broadest exposure, the cheapest fee, and the longest track record. Notice the pattern here. As the advertised yield goes up, so does the concentration in the risk. That's not a coincidence, it's the trade-off you're accepting every time you reach for a bigger number. Where GPTY fits for you depends on your objective. If you specifically want higher weekly cash flow and can accept the concentration that comes with it, GPTY sits in a reasonable middle ground. If you'd rather have broader diversification with a smaller but steadier income stream, JEPQ or QQQI deserve a serious look instead. So, where does this leave us? GPTY can provide substantial weekly cash flow, and it offers broader exposure than a single stock YieldMax ETF built around just one company. That's a genuine advantage over some of the more extreme products in this space. But it should not replace a diversified core portfolio, a bond allocation, or a long-term growth strategy. It's best viewed as a small satellite position, a deliberate slice of your portfolio dedicated to extra income, not a core holding you build your financial plan around. The full breakdown, including the complete distribution history and a deeper look at the tax side of things, is linked in the description below, along with my model portfolios if you want help structuring how a fund like this, or a lower risk alternative, fits alongside the rest of your investments. If this video helped you understand GPTY a little better, give it a like, subscribe for more breakdowns like this one, and let me know in the comments. Would you use GPTY as a satellite position, or would you rather stick with something broader like JEPQ or QQQI? Thanks for watching, and I'll see you in the next one.